Hi everybody, this is Ellman, the Blue Collar Investor. Today we're going to discuss the difference between trading stocks and writing covered calls. In the example of trading stocks, basically we're buying and selling stocks. When we're selling covered calls, we're buying the stock but also integrating option sales into our strategy. First, let's look at the objectives. When we do stock trading, we buy a stock and we hope that stock appreciates in value. If it does and we sell the stock, we've realized a gain. Now, to protect ourselves from the downside, some investors will actually set what's called a stop loss. For example, if you purchase a stock for $50 and decide that you want to set a 10% stop loss, 10% of 50 is $5, so you'd set the stop loss at $45. Should the value of that equity decrease to 45 or less, that stock will be then sold at market. The objective for covered call writing is also to make money, but we make money first by the sale of the option. And that will generate a premium which will be sent directly to our cash account. We make money when we sell covered calls even if the stock does not go up in value. So in two scenarios we make money with covered call writing, if the stock stays the same or if it appreciates in value. With stock trading we make money only if the stock goes up in value. Now let's take a look what happens if the stock goes down in value. When we're trading stocks, if you sell the stock, a loss will definitely be incurred. Simple. You buy a stock for $50, it goes down to $48, you sell it, you have a $2 per share loss. With covered call writing, that's not necessarily the case. You buy a stock for $48, you sell the $50 call, for example, and perhaps generate $2.50. If that stock goes down in value by $2, you still have the $2.50 you collected on the option premium. So overall, you have a 50-cent per share profit. So you could still make money when you sell a covered call, even if the stock value goes down. But should it go down more than the premium you collected, you've still lost less money than the person who bought the stock and didn't sell the call option. Let's take a look at the other side of the coin. What happens if the stock goes up in value? Well, when you're trading stocks, if you sell that stock, you've made a gain in profit. You just simply take the amount you sold it for, deduct the cost of buying those stocks, and there you have your profit. When you're writing covered calls, you collect any share appreciation up to the strike price, plus you collect the original option premium. So let's go back to our example where you buy a stock for $48 and sell the $50 call. You collected $2.50 on the sale of the option, and now the stock goes up past $50, so you've made another $2 on the share appreciation for a total of $4.50 per share. Now this is the important part. You do not participate in any share appreciation above the strike price. So if you bought a stock for $48 and sold the $50 call, you get $2.50 for the option premium, $2 for the share appreciation up to $50, but if the stock then goes up to, let's say, $52, you do not get that extra $2. And when deciding on whether this is a strategy for you, you have to realize that you do not get any share appreciation as profit above the strike price. So the appreciation is limited by that option sale. Let's take a look if you don't sell your stock. In stock trading, if you don't sell your stock, you neither have a loss or a gain. Now on paper you may feel like you have a loss or a gain, but in reality you do not. In covered call writing, when you sell the option on the stock that you already own, you do have a profit that was generated from the sale of that option. Even if you don't sell the stock, that option profit is yours to keep no matter what. So that brings us to the point of compounding, which in my view is the eighth wonder of the world. Compounding your profits is what's going to make you wealthy. So let's take a look at the two examples and see when we can begin the compounding process in each case. For stock trading, you have to wait for your stock to generate a profit, for your shares to go up in value. If and when that happens, you then have to sell the stock and take that profit, and once you have that, that can be then generated back into your portfolio to start compounding your profits. With covered call writing, it's much better. What happens is you sell the option, that cash is generated into your account in seconds and available for trading at the latest by the next trading day. So you can actually start compounding your profits immediately with covered call writing, whereas with stock trading, you have to wait for your stock to go up in value and then decide a price point that you're actually going to sell the stock so that you could start compounding your profits. Let's take a look at the due diligence or the time required in each type of strategy. When you're trading stocks, this is more or less long-term investing, and it requires minimal time compared to covered call writing. This is actually an advantage for stock trading. As I said before, some folks will actually use stop losses so that they don't even have to keep constant track of the amount that their stocks are trading for, and those stocks will be sold automatically if the shares drop to a certain price point. Covered call writing is different. Because we sell predominantly 1-month options, it requires us to check our accounts on a daily and weekly basis. Daily basis, basically we want to take a look at the value of our options and the price of our stocks. Usually this only takes a couple of minutes a day, but we must have an organized watch list where we can access the information quickly. Total, I would say a few hours a month if you trade as many options as I do, which is about 50 to 70 contracts a month and between 15 and 25 stocks in my portfolio each month. You have to remember now that options expire. Stocks do not, unless they go bankrupt, which is a rarity. The options expire at the end of the contract period, and that means that we must establish new positions every month. So the due diligence required for covered call writing definitely is more involved than that for ordinary stock trading. But the amount of income that you're going to generate by doing this will make that time well worth it. So let's take a look at our option profits. Historically, the stock market goes up approximately 10% per year. It was actually a little bit more than that until the debacle of 2008. Covered call writing, when done properly under normal market conditions, can generate 2 to 4% per month. You could see the results crushing that of ordinary stock trading. Now, whether or not covered call writing is right for you, only you can decide that. What you have to do is learn the system. Learn exactly what covered call writing is all about. It'll be worth your time and effort. Even if you decide that you're not going to do it, education could never hurt. And if you feel that covered call writing is right for you, it could be fun, it could be entertaining, it could be educational, and it could be financially rewarding. And in many cases, it could lead to your financial independence. I hope you found this video useful. I could be reached at Alan@thebluecollarinvestor.com, or you can get a lot more information on covered call writing directly from my website at www.thebluecollarinvestor.com. This is Alan Ellman thanking you for listening, and I look forward to hearing from you in the near future. Take care, everybody.